Welcome for all of you who don't know me. My name is Sapna Shah. I'm the founder of Retail X Series. I'm also an angel investor. I invest in the future of retail at the pre-seed stage. This should be a great session. I'm really looking forward to it. If for those who can't stay the whole time or would like to see parts of it again, we will be recording. We're already recording. And the session will be put up on the Retail X Series YouTube website probably sometime this weekend. So in case you missed any of it, we are going to start with a moderated discussion, and then we're going to get to Q&A at the end. So if you have questions, put them in the chat at any point during the session. And like I said, we'll get to them in the end. And then the next few sessions in November and December will be announced next week. If you're on this email, if you're on this call, you will get an email about them. But we will be doing more sessions on B2B sales and financial modeling and some brand building and some other things. So look out for that email in the next week. And so without further ado, Erica, welcome. Welcome to Retail X. Can you tell us
Hi,
a little bit of
me.
Yeah, can you tell us a little bit of your background, kind of your role at 1000 Angels and Rain Ventures, kind of your focus?
Yeah, sure. Okay, so hi everyone. My name is Erica Duignan Minnihan. I am founder and managing partner at 1000 Angels, which is a fintech company that essentially helps to ease the flow of capital between high net worth individuals and early stage companies that are looking to fill out their rounds. So we help our investor clients build a portfolio of direct investments into companies that are essentially seed to Series B stage in tech and tech-enabled companies. And I'm also founder and general partner at Rain Ventures, which is a seed stage fund that invests in very similar style assets, but through a fund structure. So nice to meet everybody. I'm really excited to talk about fundraising. I've actually been an early stage investor for the last 14, almost 15 years now. And, have lots of interesting advice and experience to share about how you can hopefully make the fundraising process a little bit less painful.
I mean, if only, right? All right, well, I'm excited to have this conversation. So let's kind of start with the basics. So a lot of the founders here are kind of at pre-seed, just raising, maybe thinking about raising, or maybe are starting or have raised some friends and family, something like that. So at this stage, as founders come to you, what do you expect to see from them as they're kind of starting their first really outside capital, outside of friends and family? The deck, obviously, but what else? What should they be prepared with?
Yeah, so, I think that it is really important to, sort of start the process early. And, I think what for me as an investor, one of the things that's most challenging is, if I meet a really great company, but they sort of think that, funding is kind of going to happen overnight. So, sort of starting the monitoring process as early as you can be really helpful. So that means, making sure that you are tracking metrics, even if your company's pre-revenue, whatever sort of data or metrics you can be tracking, from launch to where you are now. As well as potentially doing monthly investor communications so that you sort of have a history of, whatever it is you're reporting on, so that we can actually see sort of the progress of the business. So I would say, I'm going to want to see, the basic diligence materials, right? Which are, investor deck. Hopefully you have a 5-year financial model, marketing plan for, companies that are, and that can be in the investor deck. But if, marketing is a part of how you need to acquire customers, your marketing plan. Usually there's a cap table. I know, we're talking about really early stage companies. So 100% of the equity might still be with the founder. And so it's probably not going to be complicated, but, we usually want to see a cap table. And, besides that, I think it's really being able to meet with you and, hear about your idea for the business, the current status of the business, but more importantly, your long-term vision for the business and knowing that you have a really solid grasp of where you expect this business to go over the next 5 years. The other thing that I think is really key, and I know that it's probably a big thing that you guys are working on, as I heard you discuss your future topics, is that, if you are CEO and founder of a company, and you're out raising, to make sure that even if you paid somebody to help you out with the financial model, that you really have a good command of everything that's going on in it. So, being prepared from the position that you can present your investor presentation, you can do a walkthrough of your financial model, you can explain your marketing plan. All those things are really critical when you're sort of at that first stage of outside capital.
I am so glad that you mentioned that, because I think one of the reasons we do the financial modeling session for RetailX founders every year is because I think, numbers can be scary. Those Excel models can be scary, but you do need to know them. So I really appreciate you talking about that. The other thing I wanted to pick up on that you mentioned is a marketing plan. So when you're thinking about this, I think for a lot of particularly D2C companies, they might have one slide in their deck that says, we're gonna have influencers, social, like Instagram and Facebook, and we're gonna run a referral program. Is that what you mean by marketing plan? What do you mean by marketing
Oh, you're so funny. So yes, what Sabra's getting at is that, and it's actually really funny because we're in the process of doing an investment in a D2C hair care startup, where the founder is, a really long time experienced entrepreneur who's been in the music industry, and she's, been at L'Oreal, and she's on the board of Revlon, and, just a really, really experienced marketer. And, she was doing her pitch and she was saying, yeah, we're not doing marketing, right? We're actually marketing. And so there's a huge difference between what Sapna was just talking about, which is marketing, right? Which people think, oh, that's my marketing slide, and then real marketing, right? So when we talk about marketing, particularly for an early stage company, we want to know, what are you possibly doing that is going to give you a competitive advantage in reaching the customers, right? Like, what is it about what you're doing that is sort of a unique channel or a different channel? You can't just say, paid social and influencers and sort of expect investors to kind of pay for you to either acquire customers at market price, which, the whole point of doing a startup is that you feel for some reason you're able to, acquire those customers more cheaply, or to sort of make mistakes on customer acquisition with our money. So, really coming with a plan to show, okay, what are some good examples? Oh, so like one of the D2C consumer companies that we're in diligence with right now, and content is a huge one, right? So, they're selling like baby clothes, but instead of sort of marketing it with traditional Instagram and maybe trying to get it into Walmart or Target, they're actually like creating these mommy and me classes online for the clients, right? They're creating sort of interactive digital content, and they're using that as their marketing channel to actually sell the items. That's a unique approach. Another one, this hair care brand that I was talking about, they're sort of targeting a certain segment of the market that's very reliant on video tutorials and sort of walking people through. So really having something that's like, okay, what is your unique approach to marketing? What are you doing that is appropriate for your company that you're able to sort of control and own the IP over, that is giving you unique access to this customer? Another example is we have one fintech company in our portfolio with a great startup founder, beautiful woman, smart woman. This is her second startup. Her previous one was very successful. And, we were doing sort of an investor advisory call last week, and she's like, yeah, do you know any influencers who would maybe, be willing to create content or for, our fintech platform, would want to talk about it, and I'm like, well, honestly, I don't really know any, sort of cool millennial, women that are, intelligently talking about financial planning really out there. And I was like, you should be the person, right? I mean, that's actually even better, right? If if you're able to sort of build those marketing assets and those customer acquisition channels like in-house. So, it could be a variety of different ways, to connect, resonate, acquire your customer. It could be some sort of strategic partnership that you have that, other people haven't got access to or haven't thought of. So just make sure that whatever it is that, it's something that's thoughtful, it's something that's innovative, it's something that is going to really prove to investors that you're creative about customer acquisition and that you're able to do it more efficiently. And by that, we mean, at more scale and specifically more cheaply than kind of, the standard create Facebook and Instagram ads and, see where it goes from there.
Thank you. Yeah, I totally kind of laid that up for you.
You did. And there's another thing that I would like to recommend. This book's actually kind of old now, but I think that it's so valuable from just the way that it gets you to start thinking about marketing in the right way. And the book is called Traction. I forget the authors. I feel like I know one of them. He was actually in one of my accelerators, but it's called Traction and it has a yellow cover. Oh yeah, I don't know. That's probably it. My copy is hardcover, so it has a little yellow cover, but it really very much like, and it's a bit old, maybe it's been updated now, but it lays out all of the different traction channels that you can kind of have for your business. And even if, you don't end up using one of those, by reading the book, it sort of gives you like a good mental picture of how to decide where to focus your marketing and customer acquisition efforts and how to sort of evaluate, where you should focus your time and energy. So good to see you have that on the shelf.
I will admit it's on the shelf, but I've never read it.
Oh, well.
Okay, so that was really helpful. So that's kind of how you need to be prepared to go into a fundraise. Now, how do you look for the right investors? Like, how would a founder on this call know that you were the right investor for them?
Yeah, I think that, okay. So first of all, the sort of first thing that you want to do is, figure out who's kind of investing at your stage, right? So when you're very early stage, there's going to be a vast majority of firms that, already are not appropriate for you. So think about sort of stage and size of round. If you're doing your first round and it's maybe 1 to 2 million, there are a lot of firms that you've probably heard of that, are not going to be ready to write a check. That being said, I think it still makes sense to start developing relationships there because, as I said before, you always sort of almost want to start like a round or two before you're actually appropriate for a certain fund, to start communicating with them and potentially updating them, getting on their radar. That way, by the time you actually need to raise the money, they feel like they already kind of know you well enough to be able to write a check quickly. If, it's time to raise the money and they're just meeting you, it's probably going to take like 6 to 12 weeks if you're lucky to actually get everything done because, they just met you, right? And they're unfamiliar, even if your company's doing great. So that would be one thing. The other thing is, people who hopefully are focused on your specific sector. And so while that, can be great, the only sort of challenge there is, definitely if it is somebody who's like very, very focused on your particular thing, and maybe it's, a sector that, I don't know, doesn't, isn't really, I guess, favorable to investment or whatever, there's going to be a little bit more competition for you to sort of get noticed by that investor. So whatever it is that's defining about you, see if there's a fund that actually has that as part of their thesis. We all know there's like relatively, money out there, relatively little money out there going into female founded companies. But there are some firms that, are focused on only investing in female founders. There are firms that are focused on, maybe only investing in retail. So, do a little internet search and see, are there some funds where, you actually meet part of their thesis? It'll make the whole process go along more easily. Once you kind of narrow that down, definitely, make sure that you reach out to them. But, I personally think that at the early stage, unless, there are a lot of generalists. And so unless an investor like clearly is not investing in what you do, right? Like, let's say you're doing retail, but this is like a deep tech fund, there's no point reaching out there. But with early stage pitches to sort of more generalist stage focused investors, even if they don't have like a very specific thesis that lines up with your business, these conversations can actually be very informative and enlightening to you. So, when we're making investments, on average, we'll, for every about 100 companies that we talk to, we'll end up making an investment in one. And, truthfully, even though the investment rate, right, is somewhere around 1%, that doesn't mean that, the 99 ones that weren't a fit weren't good companies or, didn't have some merit in some way. So, you kind of have to realize that, number one, there's a very low hit rate for, exactly like sort of the timing being right and the stars being aligned between you and an investor. So don't be afraid to kind of like take more meetings. Just remember that if you're taking more meetings, use them sort of as a way to increase your own information base, right? So let's say you were having a meeting with me, you've got a company that does XYZ. Like, for example, I was judging, some pitch competition yesterday. There was a woman there who, had a company with a consumer product, like something that we would never, ever, ever invest in just because like it doesn't really sort of meet our investing style. But we were able to give her a lot of kind of like positive information and useful feedback, like during the pitch and during the conversation. So if you go into all of your kind of investor pitches and the way that you think about, going through your potential investors, from the perspective that I'm here for two things. I'm here, one, to learn from this person's experience, right? And so while, they probably don't know as much about your specific product and sector as you do, they will probably know a lot about sort of the peripherally competitive market, right? Because they're talking to other companies every day, and as well as sort of about the fundraising landscape. So one, I'm there to learn, whatever I can from them about topics that they might be aware of that I don't know. And number two, I'm here for, the 1% chance that this person might actually write me a check. And so that would be great. So let's say that, it does end up with, a match and interest. Just more specifically answer the question around, what should you be looking for in an investor is, to realize that particularly at the very early stage, you are likely going to be in a relationship with this person for a very long time, should your company, not go under and end up being successful. So you want to make sure that you have like a good rapport with the person, that, you feel comfortable that they can sort of take like a professional approach to the relationship. Some of the things, that are a little bit of like red flags and danger signs at the early stage are, people who, maybe have ulterior motives for why they want to invest in your company. Maybe they're going to be like constantly chasing you for information, or, they want to almost be, more involved in it, than you want them to. So just make sure that, you feel like you can trust this person, that there'll be a professional relationship around the investment, and that you'll feel really comfortable kind of, being locked into a relationship, a friendly relationship with this person for the next decade. And that, you're fairly certain that they, number one, have your best interests at heart, and number two, are going to support you rather than hamper you in growing the business.
I'm so glad you talked about that. I think for a lot of founders, the earliest stages, somebody's offering you money, you're like, I just need the money. I just need the money to continue on. And then you get into these relationships with investors who maybe don't have your best interest at heart or turn out to be a complete pain in your ass, for the next 5 to 10 years. So I'm really glad you brought that up. I think that's really a critical point. Um, I want to switch to talking a little bit more about the current.
And wait, and the worst thing is it'll have been for like $25,000.
Right.
So for the next 10 years, you'll be driven crazy and you'll be like, that wasn't worth $25,000.
It's hard in the moment to recognize that, but I 100% agree with you. Okay, so I want to switch now to talking about the current environment. So, we're kind of, I don't even know, 8 months, 7 months into COVID, 8 months into COVID. People have not been pitching in person. Certainly different kinds of companies have really boomed, and certain other things like, for example, men's suiting maybe hasn't done as well. What kinds of things do you see that are interesting right now, like in terms of types of companies, products, business models? Has that changed for you? Or has COVID really not changed those things for you in terms of what you're looking for?
Yeah, no, I mean, it's definitely changed. So, I mean, we've been fortunate, just because you'll know that like the vast majority of sort of early stage investors focus on, tech or tech enabled companies because they have scalable models. So, anything that has sort of, digital distribution or D2C, or, can sort of really take advantage of what's happened with COVID has actually done better. We're lucky we actually had like an ed tech company in our portfolio. And like, prior to COVID, people were like, I don't want to touch ed tech with a 10-foot pole, and for very good reason. But now that's all of a sudden like a very hot area. Healthcare technology, same thing. We just kind of got lucky that we had a couple, healthcare technology companies in our portfolio, like that we had invested in the year before COVID, even though people also kind of hate that sector for good reason. Because so people hated ed tech and health tech just because the customer adoption cycle is like really, really unpredictable and, can be a nightmare. So, for whatever reason, you guys are probably aware that both in education and in healthcare, they're like really resistant to any new technology. I remember when my daughter was in like 5th grade or something, I was asking the principal, like, oh my God, like, why is it always like notes stuffed into backpacks? Like, can't you just send me an email? And this was probably in, I don't know, a few years ago, like, man, she's in 10th grade. So yeah, 2015. And she was like, well, we can't do that. Cause like, what if everyone doesn't have an email, but it was like, they are just like to the death resistant to like convert anything from analog to digital. They will forever, sort of hold on to it. So now that's all like totally gone in the crapper, right? Like they're forced to, right? So rolling back of all the regulations, preventing people, or highly, regulating the way technology is used in healthcare. And then as well as the fact that, sort of from all angles, education has sort of been forced to digitize. So we've seen a lot of cool stuff happening there. And then, we have another one that's sort of like in the fitness tech space. So, that's health to like a certain perspective. But yeah, I mean, there's been a lot of, change, and even, the one thing I'll say that's interesting about this experience is that, none of our portfolio companies went under because of COVID. The only portfolio company I've had really in the last like 5 years that sort of like, ended up being a bust was somebody who was in the cannabis space. And that's because, unexpectedly they like decided that the CBD was not to be used in food products anymore, kind of out of nowhere. So, those sort of regulatory changes can really, sort of end something unexpectedly. But, Surprisingly enough, a lot of our founders have been like scrappy enough to kind of figure out how to get around COVID. And I mean, one of my portfolio companies literally is like a huge massage on demand company, and they actually managed to figure out how to pivot around COVID. So if a massage company can figure it out, I was shocked. I was like, I thought they were just going to be like, hang it up, but if they can figure out a way to make money in COVID, hopefully, everybody can figure out some way.
Great. So now I'm going to ask you like the $1 billion question that I think probably every founder asks you is, what do you see happening in terms of valuations right now, round sizes, particularly at pre-seed and seed? And what do you have a viewpoint on kind of where you think they're going?
Yeah, I'd say that okay, so I've been doing this for 15 years and so I have like some pretty good market perspective. I would say that valuations are pretty much like reasonable, at least for what we're talking about, which is sort of like pre-seed to Series A. So, it was really funny because one of our portfolio companies just got like a $2.5 million seed round done. That first round was leading. And it was funny because like, I noticed that the valuation was like kind of like good, reasonable. Like it wasn't really sort of getting pushed up. I think it was like a 2x on the post money from our previous round, which had been like a year earlier. And, it was funny because I think that day, like the partner who was working on the deal had tweeted like, oh, I think it's funny when, pre-seed investors like brag about their markup to the A round or whatever. Like it's a marathon, not a sprint. And I was like, oh, well, you're saying that because you want your valuation where you come in to stay low, but I'm sure you want, a 5x markup on the next round. But I just thought it was funny. So, but it was a good example of, we have to realize that there is sort of like a whole life cycle for the company. I'd much rather see a company partner with a really, really great or a couple of really, really great VC firms that are well capitalized and to do, appropriately sized rounds at appropriate valuations, through sort of a partnership, right? So, when things kind of like get out of hand, I guess, I don't think it's healthy for anybody in the system. I think that my rule of thumb for founders is that if you want your investors to be happy, right? So if you think about the fact that in the life cycle of a company, you're probably going to need to raise every 18 to 24 months. If you want your investors to all be happy, the pre-money valuation of your current round should be double the post-money valuation of your previous round. Like that would sort of be your ideal scenario where, everybody's kind of thrilled, right? So if you're doing, an initial $1 million round and, your pre-money is 4.5, right? So post-money is 5.5. Then if the pre-money on your next round, a year and a half or two later was 11, all your investors are going to be thrilled, right? So on 11, you might be able to raise another 3, right? And then your next round of, 10 million might be done at say like a 30 or something. So this is kind of like really healthy growth where you're protecting your equity position in your cap table, but the whole way along, you're going to have absolute support from your investors because they're going to be thrilled about the returns that you're creating for them. And so it's always going to sort of keep that access to capital open to you. And it also sort of minimizes, the return demands that you're going to have to deal with. So if you've kind of always raised money at, what I guess we would call them sane valuations, things that sort of work for everybody, you're always going to have sort of the support of your investors in any next round. And when you know, are ready to sell the company or have a liquidity event, you'll have more control over sort of the outcomes, because you haven't sort of, you know, priced yourself to demand, you know, $1 billion exit for it to work or something like that. So, you know, I think that right now, like, valuations feel fine. I don't feel like they're low. I think, you know, people kind of thought, oh my God, because of COVID, valuations are going to go down significantly. I don't think that they went down, because, you know, there is such a thing as too low. But I do think that, you know, they're kind of in a stable place that's, you know, not frothy.
Got it. Yeah, it was interesting because when I was first having these conversations, when we started going virtual for RetailX and talking to a few VCs who I had on for these sorts of chats, they were all expecting, you know, kind of 30% lower valuations, particularly at seed, maybe more. You know, there was so much uncertainty in what happened. And I agree with you. Like, I have not seen valuations get really low. I think there are still some founders who really are looking for that pre-product, pre-launch $10 million valuation, which I personally would never invest at. But you know, I think they, generally speaking, it does feel kind of more sane and not like there are bargains to be had everywhere from the investor perspective.
Yeah, well, you know, it's a tricky thing, right? So, you know, just for, I mean, obviously Sapna knows this, but, you know, for you guys, um, you know, unfortunately, like, there's no way to put your equity on sale, you know, like, there's no such thing as discount, because, you know, like, for example, we have this one company in our portfolio that we had invested in pretty early. I want to say we did the first investment in like 2018, and she was just having a really hard time like getting a Series A done. And, you know, she had sort of been issuing convertible notes like drip by drip, I think starting at like a $3 million pre-money, like 3 through 5. And so finally she was able to find a group to lead her Series A. It's an investor group that, you know, I personally think, like, I hate some of these investor groups that bring together like, you know, inexperienced folks to essentially like practice on startups, right? Like, practice their negotiation skills. And, you know, one of the things that the new investor, who wasn't even bringing in that much money, told her to do was to renege on all the valuation caps she had, you know, agreed to for her entire cap stack. And, you know, she was, I guess, just really needed the money, you know, and agreed to it. And I was like, you know, number one, that's not a good way. There are other ways to create additional equity in the company if you need it. That's not a good way. You know, number two, that's a great example of, you know, sort of burning your previous investors. Even though it seems like it's not that huge of a deal, you know, it's still kind of a, you know, a little bit of a lapse in trust. But what was my overall point with this? But so anyway, so, you know, point was that because these notes had sort of been offered at too cheap of prices, in the end, you know, the price had to be readjusted. So I guess my point to you is that for us, you know, it doesn't matter how much lower you make the price. Like, if the business isn't working, like, a lower price is not going to make a bad business work, or bad investment work. So, you know, it's a little bit of a slippery slope. Like, ideally, you should be in a position with your traction and your revenue potential and what you've built, you know, that you can raise, you know, on a $4 to $6 million pre, you know, for early. So, you know, discounting the equity doesn't necessarily, you know, is potentially going to put you in a bad position, and is potentially going to end up, you know, in sort of disappointment, or, you know, some sort of recap for those investors who were promised the cheap equity.
Yeah. Fair point. Okay, I'm going to move to the audience questions. So we've already got a few, so I'm going to read them out loud. And if you all have other questions, please put them in the chat. I still have more questions, but I think, well, let's move to the Q&A from you guys so we get through them. The first question is, how do you build relationships with investors during COVID times where you can't network with them face to face, especially if they're not on social media?
How do you build relationships with investors? Well, I mean, first of all, like, I don't feel like I'm going to things and networking with people face to face. Like so things like this, pre-COVID, I would routinely do. The only difference is that, like, I'd have to leave my home and go somewhere in the rain and, be sitting there. And then afterwards I would, like, really quickly probably try and run away, and get back to my desk. So, I don't think that you are, your opportunities are diminished in any way because of COVID. It probably is actually easier for me to take meetings with startups now because I can do it on Zoom. I think that if there's somebody that you really, really, really want to pitch your idea to, and you think that this is appropriate to them or helpful to them in some way, just send them an email and say, hey, I'd love to, book 30 minutes with you to talk about my company and pitch my startup. Just remember that, like, as investors, like, our literal job is to try and look at all the startups. So as long as, it's something worthwhile, we're both going to learn from the experience. So never be afraid to ask. If it's a specific firm that, you're interested in, maybe it's like a later stage firm, you can definitely, reach out to one of the more junior people. Like, if you request an audience with them, like, they literally will have to give it to you because that is their job to, like, and they're freaked out that they're ever going to, like, miss something. So, it's easier to sort of request a meeting than you can. Almost every single VC's email, protocol is first name at, like, their website.com. So, I like almost every single one. And, it's really easy if for whatever reason that turns out not to work, to sort of, like, figure out how to email that person. Connect with them on LinkedIn. If you go on LinkedIn, almost everyone's email is also available on LinkedIn. And like I said, you think that, like, networking is really the important part, but what's actually more important is for them to follow the progress of your business. So just remember, these are financial people. Like, investors do care sort of about what you're building, but at the end of the day, like any fund with LPs, like, the priority is to find successful investments. And so, the only way that they can know that, this is potentially a successful investment is, if they've seen some sort of, like, proof of growth in a company, right? So one of the things, that I love, I think I actually heard this from Steve Blank. I was one of his assistants for Lean Launchpad at Columbia last year, is that, when people talk about hockey stick growth, right, they forget that there is a flat part to the hockey stick, right? So we know that there's always going to be a period where the company is in the flat part. And as VCs, we're sort of trying to avoid investing in you until, that starts happening. So the only way for us to, like, observe the flat part and know, oh God, it's time, let's get in there with the check, is for you to kind of, be regularly updating us. The other thing too is, like, if you just, pick these people that you're interested in developing a relationship with, and you put together sort of a short, informative, monthly update, they're going to see it. They're probably not going to fully read it the first time, but it's sort of going to be in their subconscious, and maybe 4 or 5 months in, when your business really starts to take off, they're going to be like, oh, wow, Luke Luckett. Wait, I know that guy from somewhere. Where do I know him from? Or, Jessica Morelli. Oh, wait, no, I've been, so it'll, like, breed this sense of familiarity, even if they've never met you in person, even if they've never, taken time. They'll go back through their emails and they'll be like, oh yeah, this person's been, like, giving me updates on their company every month. Like, wow, I see that, there's an inflection point. And then, they'll probably be reaching out to you when that happens. So I think that, use your digital tools, don't worry about, cocktails and whatever. There's a lot more efficient ways for you to network with investors by bringing them a great deal to invest in.
Exactly. That was great. That was perfect advice. I love it. Okay, next question. I've been told that you should have 2 founders when seeking funding. I understand the value of 2 founders, but it seems not organic for me. Is having a solo founder a bad thing? Do VCs view it as a bad thing?
Yeah, they do. And so the reason is not that you're not awesome and not that you can't possibly like build the company on your own, but the reason is that the hardest thing to do in a startup is to build a team. That is absolutely the hardest thing. So if you like, for example, if I look at some of the companies I've invested in that have not been so successful, have not been successful raising money, have not built team in the right way, it's usually because there's a solo founder. And so it's kind of like a negative signaling, because what it sort of shows us is that you can't necessarily, number one, find somebody who's like as excited enough about your idea as you are. Like you weren't able to convince somebody to get as excited about your idea as you are, and that you're also possibly not really good at building team. So, if you don't want to give this person like a founder title, like that's fine, but you need to build a management team. And so we always think about management team, probably for the type of company you're building, it would probably be CEO, COO, and CMO. For more of like a tech focused company, it would be CEO, CTO, and COO. So like really those 3 roles are important, and if you don't want to call someone co-founder, that's fine. You don't have to, but what you need to demonstrate is that it's not just you, and that you've got, 1 or 2 really amazing people that are excited about building this company with you.
That's great advice. Thank you. Next question. I'd like additional members of my team to attend pitch days. These past few months, I haven't seen as many B2B pitch sessions, demo days, especially in retail tech, fashion tech. Is anyone seeing this too? Any upcoming virtual retail focused pitch sessions that you're presenting at or recommend? This is really a question for everyone. I would argue that anybody who has an answer to this should put it in the chat. I think there's actually one that I can email out to everybody afterwards, because I have seen a recent an advertisement for one of these. What I'm going to say is I think a lot of these events that used to be in person, not all of them transferred to online. So I think there were more events, and I think they're a little bit harder to find. So I think there's a little bit more kind of reading like Gary's Guide and all these other kind of newsletters, Marcos's newsletter about like what events are coming up. But I agree, there are fewer of these. So, but I will, particularly Luke, to you, since that was your question, I will find the one that I recently saw, because I know that there was one recently that's coming up.
Well, okay, you should do one. Are you doing one?
Yeah, I never really do pitch ones, but yeah, it's not a bad idea. We'll put that in the parking lot.
One, I can be a judge. I'm sure you have lots of people that you can bring in.
Okay, next question. Is it wise to share with prospective VCs your uncommitted pending convertible note deals that you have outstanding?
Oh, well, I mean, uncommitted pending. Mara, maybe you can unmute her so she can.
Yeah, Mara, we're going to need a little more information here. I think you should be able to unmute yourself, Mara.
Okay, yeah. So I have a couple of outstanding convertible note deals with prospective VCs, and I'm also speaking with new potential VCs. So is it the right thing to leverage potentially that there's other interested parties or not?
Oh, I see, but you don't have to sign a term sheet, right?
No signed term sheets.
No.
Okay. No is the clear answer. Okay.
All right. Next question. We need financing to reach the growth we believe is possible for our business, but do not need financing to survive. If we can wait, would you recommend to wait until the COVID climate settles?
Um, I would say no, because, I don't know what you mean by wait, but, like I said, fundraising generally takes a while. So, you don't need to sort of be like, I don't know, if you're okay for now and you're not worried about it, like, don't make it your 100% focus. But, at the end of the day, I think that for companies, I would say probably until they're, you know, at like Series B, maybe Series A/Series B, they kind of are, if you're looking to be venture backed, like you sort of need to be kind of almost in like permanent fundraising mode, right? And so just from the perspective of, it's, great that you hopefully have, some runway. I guess that's what you mean by you don't need it to survive. I don't know if it's because you're ramen profitable, or if it's just because you've got cash in the bank, or, when we say that, we just mean like your burn rate is, either zero or very small. But, if you have opportunities for growth and you think that fundraising would accelerate that, you want to kind of do your fundraising while you're not in a precarious position. Because the thing is, this is sort of why you always hear about companies sort of raising like bridge rounds. So, the best time to do fundraising is when you don't really need the money. By the time it gets to like you really need the money, like no one is going to give you money. You're probably going to die, or bad things are going to happen. So, make sure that, if you're okay now, that you start building those relationships, focus on growth, focus on metrics, but it's a good idea to take advantage of, reaching out to investors while the company is healthy and the outlook is rosy. So I wouldn't wait.
Great. So the next question is, how much traction is enough traction for a fashion e-commerce business to go out to investors? We've done 45K in our first quarter of marketing and over 200 orders a month with a solid team in place. Are we too early?
Yeah, I mean, I don't, I mean, 200 orders per month. It sort of just depends on what you're doing, and sort of what the story is. Like seeing, okay, 45K, so it's like 15K a month in gross revenue. So I don't know, what your net revenue is from that, 200 orders per month. I guess it sounds good, but I don't know, they must be like relatively small size orders. So what I think is more important is, when you're, okay, so when we say traction, like what we really mean is that there is something going on with the business that sort of tells us the train is about to leave the station. So you've, seized upon something that you kind of didn't see before, right? So if you were just sort of like, hey, I started a business, it's doing, $15,000 a month in monthly sales, and I have 200 orders a month, but, that's just sort of like what's happening, it's not necessarily ripe for investment. If you're like, whoa, we've figured out how to sell, product X, where, we're able to, acquire this customer for, $1. And, when they purchase whatever it is for $20, there's like a $10 contribution margin on the first sale. And, our pool for acquiring this customer, there's like millions of this type of person, and we can get them through this channel that's like very, very deep. And, we need the money to just, invest in this customer acquisition. Then it's the right time, right? So it's less around, for this type of business, it's less around like, hey, we've reached this certain milestone, especially when you're very early, and more around, let's tell the story of kind of like what you've done at a small scale, what it's creating. And if you extrapolated it with, the extra $1 million that you want to raise, what is that going to create? So I'd really kind of think about, that, like, is there something that's going on in your business that has made you feel really confident that if you had more capital at your disposal, you'd be able to grow that revenue at, 20% month over month.
Yeah, that was a great answer. I'm gonna just crib that whole answer and
Crib away. Crib away.
it is really hard because I think people hear like, oh, you need to have 20% month over month growth and then you can raise this, or at $1 million in revenues, you can raise a seed, but that's not necessarily true for every company. So it does depend. Thank you for that. Okay, next question. How do investors feel about dynamic equity split models like slicing the pie? And if that's not recommended, what other ways do you suggest to divide equity fairly at the early stage? Is there a tool to use?
Sorry, Nicole. Can you just unmute yourself? Are you talking about dividing equity between founders or equity between founders and investors?
Yes, between the founders.
Oh, okay. So give me like some more context into the challenge that you're facing.
Sure. So usually when we talk to a potential employee or founder, there's a discussion of who gets how much, and it's usually based on like emotions or expecting that in the future they're gonna put this much skin in the game, but it's not like the reality of what they would do. So then we came up with this, we came across this way of splitting, which is called splitting the pie or slicing the pie. And that says that you basically, similar to working in a big corporation, you're getting based on your contribution. So I'm just wondering like how you guys feel about that, because it's not like I get 30%, the other person gets 50%. It's something that would be clear over time. So have you heard of that, and what do you think about
Yeah,
that?
I mean, I don't know what slicing the pie is, but if you have true co-founders, you guys have to sort of decide amongst yourself how you want to split the equity. And yeah, it's going to be based on a lot of things, like probably, a technical co-founder is more valuable than, I don't know, probably even like the CEO, or somebody who's like got amazing marketing expertise, might be more valuable than, somebody who's kind of in a COO role. So really goes case by case. What I do think is important though, is that founders are issued, founder stock that vests over time, because, definitely, I've certainly had some founders I've worked with who are like really cool people who've like given equity to co-founders in the beginning, and then that person leaves and took a huge chunk of equity with them, which I think is not great. So I think that, you should figure out fairly amongst yourselves how to allocate, founders equity, and you should probably have it vest. I'd say maybe even like 5-year vesting period is probably a good call, because you don't want to, the main thing is that you don't want to lose the equity to people who are no longer with the company.
Yeah, that happens more than you think, actually. And the other thing I would say is I'm also not familiar with slicing the pie, but if in slicing the pie that founder equity is changing, that is really confusing during fundraising. Because I think to Erica's earlier point, you want to have a cap table that shows kind of who owns what. And if that is not the final, like don't throw roadblocks up in your own fundraising process. Make it as simple as possible and standard as possible. Any other questions? We've got maybe time for like one more quick one if anybody wants to put one in the chat. And if not, Erica, thank you. You're wonderful. This
Thank
was
you
so
guys.
I really appreciate you taking the time. And thank you all for your questions. This was a great session. Like I said, it was recorded, so it'll be up on the RetailX YouTube channel. You will also get, you'll be on the email list, and you'll get an invite to the RetailX Slack channel if you're not already on it. And look out for an email about future RetailX sessions. Thanks, everyone. Thanks again. Thank you, Erica.
Thank you guys. And I put some notes in the chat for follow-up info.
Oh, appreciate it. Appreciate you sharing your contact information.
Yeah, really good to see everybody. Thank you. You guys have an awesome rest of the week.
Thanks. Bye-bye, everyone.